Hello and welcome to the fourth edition of our Investment Insight series, Magellan Minutes. Unfortunately, due to COVID, we found ourselves broadcasting via Zoom yet again. These challenging times continue, but we are hopeful that we'll be back in studio again very soon. My name is Jennifer Herbert, Key Account Manager at Magellan, and in this session, I'll be talking with Joyce, Head of Technology, Communications and Media. We'll be discussing the tech sector more broadly, Facebook's name change to Meta, and interesting insights from Alibaba's recent Investor Day. Thanks for joining us, Ryan.
It's a pleasure, Jen.
Ryan, many believe the tech sector broadly is overvalued. Do you think that's a fair comment? And if so, perhaps you could talk us through how you see the sector generally.
Sure. I think firstly, it's important to recognise that tech's a very broad area, and so to try not to kind of generalise too much. But I will make some observations. So I think 2020 and 2021 were really kind of this perfect storm for share prices of technology stocks and growth stocks more generally. And there are really two key dynamics at play. First of all, we had this massive change in the behaviour of consumers and of businesses that resulted in a lot of tech companies in particular reporting higher than normal levels of growth. And in a lot of cases, that growth was being extrapolated into the future and resulting in investors being willing to pay more for those companies. Second, you had an increase in speculative behaviour more broadly, driven by a combination of the lower interest rates, stimulus programs, people being unable to spend money on going out and travelling, as well as the creation of these COVID baskets and baskets of other thematics like the metaverse that really paid very little attention to the underlying value of the businesses in those baskets. And just to highlight, I guess, some of that speculative behaviour, venture capital funding in 2021 was around 600 billion. That compared with about 300 billion in 2029. And in the US in 2021, there were around 1,000 IPOs, and that compares with around 200 to 300 on average over the past 2 decades. And both of those can be really thought of as insiders selling parts of their business at what they think are attractive prices. Now, in the second half of 2021 and early 22, we have seen some of those dynamics start to reverse as interest rates have increased, as stimulus programs have been withdrawn, and as consumer and business behaviour does start to normalise. And that has resulted in some pretty brutal stock moves as markets have built in more realistic growth forecasts and pay more attention to the long-term earnings power of those businesses. And just a few examples on that, we've seen Zoom, which we're using today, fall from over $500 to $170 a share. We've seen Peloton fall from $160 to $35 a share. And we've seen DocuSign fall from $310 to $135 a share, including a 40% move in a single day. And plenty of other stocks have seen similar magnitude moves. Now, the important question is where do we stand today? And my view is that despite some of these recent moves we've talked about, and putting to one side the potential for the impact of further increases in interest rates, there is still a lot of speculation in the market for high growth businesses and these so-called COVID winners. And so as that behaviour continues to normalise, and that is reflected in the company's upcoming earnings and their guidance, I do think we could see more pressure in that part of the market, including some more big negative moves like we have seen. Importantly, I would add that while full by historical standards, we do think valuation of the large cap profitable tech companies like Alphabet and Meta and Microsoft are quite reasonable when taking a long-term view, although you could obviously see some volatility there in the near term also.
Facebook recently announced the name change to Meta. What do you think are the reasons behind the change when Facebook is such a household name?
Sure. It's a good question, and we're obviously speculating a little bit as to their true motives, but I think there's probably two main reasons for the change. The first is signaling that Meta is more than just Facebook. Instagram, for example, is a very material part of the business and growing a lot faster than the core Facebook app. WhatsApp has billions of users that it doesn't really monetize today. And as reflected in the name, it's investing a lot in the metaverse and in AR and VR, which it views as critical to its future. Now, the second reason we think is it's trying to create some separation from that constant stream of criticism and negative press that's really directed at the Facebook app in particular. I think it'd prefer not to have that criticism kind of attached to the parent company, not have it attached to the employees that work there and impact their morale, and not have it attached to any new products that they release over time. Now, whether that will work as intended is hard to say.
Meta also revealed that it expects to incur a $10 billion loss from its new Facebook Reality Labs segment in 2022. How does that impact your view on Meta as an investment?
Interestingly, not that much. I like to think about that $10 billion investment or loss as a mix of defensive and offensive investments. So starting with the defensive aspects, incorporating AR and VR features and capabilities like filters into its apps is really important for Facebook to remain competitive with the likes of Snapchat and TikTok, particularly for younger users that tend to be early adopters of these types of features and where Facebook is a bit more challenged. So investing in that is not really optional for the business. On top of that, Meta's investments in VR headsets like its Oculus Quest or smart glasses like its Ray-Ban Stories are important as they represent potential form factor changes for some of the key use cases of its apps. And historically, those form factor changes, whether it's PC to mobile, are where you can see industry incumbents be displaced or challenged by new entrants. So investing in these new form factors, even if they don't become particularly widespread or increase your profits, can be viewed as defensive and really protecting what you already have. Now, in terms of the offensive elements of its investment, there's clearly a large long-term opportunity related to being a key participant in the metaverse. But at the same time, it's still very unclear what exactly the metaverse will be, when it will be, how popular it will be, how important a role Facebook will play in it, notwithstanding that significant investment, given it will be competing with the likes of Microsoft, Apple, Roblox, and many others. And so we don't know how much money it's going to make from it. So given that and those defensive elements that I talked about, we don't think it's appropriate to adjust Meta's earnings or its PE for that $10 billion it's investing each year. We think of it quite differently to something like Alphabet's investments in the cloud, where we have much higher conviction in those investments generating meaningful incremental profits over time. So that's why it hasn't really changed my view.
Okay, now I do want to touch on Alibaba. We've spoken at length about the company, but they did hold an investor day recently. Did anything new or exciting come out of that?
Absolutely. So with regard to the core commerce business, which is a lot of the company's profits, I think the management team did a good job of explaining the near-term investments it's making in its multi-app strategy and the different fulfillment models that it's using to target different customer groups that exist in China. And also the investments it's making to deal with the increased competition for users, particularly in lower tier cities. So both of those are weighing on near-term results, but it was encouraging to see where those making those investments and the long-term focus they have that should kind of strengthen that competitive position over time. Management also highlighted some additional disclosures that it will provide going forward for its China local services business, Ulama, as well as for its Southeast Asian e-commerce business, Lazada. Now, both of those businesses are loss-making today, but we do think they have significant value. And hopefully these disclosures combined with a willingness to take on kind of external capital for those businesses will see that value be reflected at some point in the future. Now, I would say that offsetting some of those incremental positives from the Investor Day, we are seeing some economic weakness in China in the past few months, driven by a combination of regulatory actions that they've taken, the ongoing COVID lockdowns in China, as well as the inflation. And so that's impacting retail sales, particularly in certain discretionary categories like apparel, where Alibaba is quite strong. So while we think that is more than reflected in Alibaba's share price, it will likely impact results for several quarters and continue to weigh on sentiment.
Ryan, thank you so much for sharing your insights with us today.
It was a pleasure.
And thank you to everyone for watching. If you have any questions, please don't hesitate to contact one of the Magellan distribution team, and do feel free to share this update with clients or colleagues as you see fit. Take care and stay safe.